morning, welcome to Ainslie News. It's Monday the 24th of August. This month is disappearing fast. Today we're talking the S&P 500 and how March was just a correction and why we haven't seen the crash yet, or the real crash. Last week the S&P 500 broke not just an all-new all-time high, but also the record for the quickest recovery from a technical bear market or 30% decline, doing so in just 110 days. We put technical in inverted commas for good reason. Real investment advice Lance Roberts penned an excellent article over the weekend that put some important perspective on that so-called bear market. An oversimplified but oft adopted definition of what constitutes a bear market is a 20% decline from a multi-year high. And so the 35% drop in March definitely ticked that box. In fairness too, it was well and truly due after the longest but most fundamentally tepid bull market in history. It made sense and no one questioned it. However, the fact that it reversed in just 110 days amid a recession certainly should raise some questions, and Roberts answered them in his usual concise and insightful way. To do so, he poses three questions that need to be asked. Namely, number one, what defines a bull and a bear market? Number two, what exactly is a full market cycle? And number three, how deep will a bear market contract? Robert dismisses the 20% definition as purely arbitrary, and to his credit, even back in May, called it just a big correction, which has turned out to be true. Spelling out his definitions as follows, the chart shows a very clear picture. We'll summarise before we get to that chart. A bull market is when the price of the market is trending higher over a longer term period. A bear market is when the previous advance breaks and prices begin to trend lower. That's pretty obvious, isn't it? So check out this next chart here, shown from around 1996 all the way to 2020, so you guys can get a pretty big picture. Bull markets versus bear markets. Isn't it great seeing stuff on a macro level? Kind of makes sense, doesn't it? More fundamentally, Roberts talks of the full market cycles that have been repeated over a couple of centuries. The same human emotion and behaviour is repeated over and over. This time is different, probably figuring dominantly in the market psyche each time. But history shows it never is. The chart below, or next shown, shows the bull and bear markets consistently follow each other and share pretty much equal time throughout history. Bit of a complex graph here, but just take a second to look at it. Full market cycles since around 1871 when they first started being measured. And so the question arises, what will the crash look like to end this bull market? Over the last two bear market cycles, ending valuations were higher than the previous bear market cycle lows. Given changes to market environments over time, we can reasonably assume the next valuation low will be closer to the long-term CAPE or CAPE average of 16.7 times earnings. However, given markets are using and pushing 30 by trailing earnings, completion of the mean reversion process will not be mild. Check out this next chart here. Bear markets can be tenacious. Look at that steep one there around 2009. And for those that lived through that, it felt like it was overnight when it did happen. To get that 16.7 earnings, you're looking at close to a 60% correction from here. Such a correction would take you back to the 1999 levels and certainly is not without precedent. It is only slightly worse than the GFC and not nearly as much as the 80% seen in the dot-com bubble bursting. Such losses take many, many years to recover from. This next chart is an inflation-adjusted total return S&P 500 journey through the years it took from each bear market to regain your money. It takes a long time to make those gains back again after these falls. Roberts concludes, bear market cycles rarely end in a month. While there is a lot of hope, the Fed's flood of liquidity can arrest the market decline, but there's still a tremendous amount of economic damage to contend with over the months to come. In the end, it doesn't matter if you're bullish or bearish. What matters in terms of achieving long-term investment success is not necessarily being right during the first half of the cycle, but by not being wrong during the second half. Different people buy gold and silver for different reasons. Come see it as a play on expected capital gains as the price goes up on all the fundamentals we write off daily. Some see it more as a return of capital rather than return on capital. i.e. insurance, when everything else looks to have large downside risk. The latter group couldn't care less about gains, and they're looking at preventing the losses that Robert warns of and the years that it takes to get back to where you already are with your gold. The difference is that you could have sold your gold and bought all those bargain shares with your insurance payout. Then, of course, you may be thinking this time is indeed different, and headlines such as Tesla breaching 1,000 PE, yep, that's not a typo, are a sign of good times ahead. The longest bull market in history has heaps left in it, and I don't need gold. Yeah, good luck with that. Luck has never been a sound investment strategy. And that's news for today, guys. Jump into our Ainslie Bullion website at ainslieBullion.com.au. If you're into crypto or interested in crypto, ainsliewealth.com.au. And if you want to have a balance between the two, check out Ainslie Bullion's own crypto product, which is a gold and silver backed token with ease of access so that you can buy, sell, and exchange to other cryptocurrencies. If you want to read more about that, go to goldsilverstandard.com. We'll catch you tomorrow for more news.